Today we'll be sharing another case study with you and just kind of the process of how we worked with them, what kind of results we were able to get with them.
Yeah, absolutely. I'm going to kind of draw this out so that we have a good visual here. But we have a client that came to us. His name is Renato. All right, there's his name. So Renato came to us paying around $45,000 to $65,000 in taxes. Now, he already had a CPA and he's had the CPA for 10 years. So we were like, okay, well, have you asked him about tax planning and things of that nature? And he had, but it just seemed like he wasn't being heard and he felt like something was off. So initially he just asked, could you just look at my 2023 tax return? So the first thing we did was we reviewed his 2023 taxes. So we looked at that and we tried to get the whole picture. So Renato had and has a elder care business. So this is the main business, and this business is run through a partnership tax return, so a 1065 partnership. But he has a lot of employees that he manages through his C-Corp. So he has this C-Corp here where all of the payroll goes through. So this pays this payroll company to take care of the employees and do all of that aspects of it. So we thought that was interesting. I've seen that before, but then we also noticed, okay, you also have this 1120S. So what is the purpose of this? And then we also noticed, okay, he has QuickBooks, so that's great for this company and also for this company. In addition to that, we're also looking at, okay, what are your goals, right? What are the goals? Renato wants to build for retirement, right? So he wants to boost retirement and also, just pay less tax. Those two align pretty well. Now, unfortunately, when we reviewed his 2023 taxes, we found a problem. And that problem was his wife was a W-2 nurse. She's a nurse, and keep in mind, his accountant, he's had for 10 years. So when we looked at it to see, are there any opportunities to mitigate tax? They did not report the W-2 from a wife's job. I don't know about you, but that is really obvious. Right. So clearly, this accountant was not paying attention to the details, even like really generic details. And so we actually had to come back to him and say, hey, unfortunately, we actually have bad news. You're gonna owe a little bit more, and you actually need to get your accountant to amend the tax return because they completely omitted your W-2. That's not the kind of result you want to get when you hire a tax planner, right? You want them to be able to say, hey, you're missing all these things and we can change it and amend and save you money. But we also need to correct the past and mistakes. And honestly, let's just say they chose not to amend. The IRS would have issued him a letter stating, hey, we can see that she has a W-2. Here's the taxes you owe and underpayment penalties and interest. So we needed to correct that. So we got that amended. But then the other thing we noticed was that the books were being done. So we got pretty okay books here. The books were being done, but we noticed that the returns did not match the books. And that is common, but they were dramatically different from the books. Like specific assets were being reported, and that can be a problem. Now, the other thing too is that he has his 1040. So this is his personal tax return. So you also need to understand, okay, how do things flow? So this is taxed as its own entity. And we noticed the prior year, he had about 18,000 in losses. And then this one has net income, which flows into his personal. And then this S-Corp also flows in here. So there's a lot to uncover. And the main thing we looked at was like, okay, well, we know we have large amounts of real estate because he has multiple elder care units that are residential properties. So some of the things we looked at was, okay, well, to me, it seems like an obvious one is a cost seg. So when we did strategies here, he was looking at potentially a cost seg. Now, we asked him about that and if his accountant had talked to him about that. He had actually heard about them, but his accountant disregarded them and said, no, we're already kind of doing that, which I don't even understand how an accountant could think that without having an engineering study. So with that said, one of the things we knew was, one, you got to fire this accountant. They're not paying attention. They're not proactively planning with you, and they're making pretty obvious mistakes. So we did that. The other thing is we asked about this 1120S. What's the purpose of this? There is a little bit of loss here, but only about $800. So, and he's in California. So even with losses, he has to pay about $800 in state franchise tax for this 1120S. He didn't even get why he still had it. So what we decided to do was, well, one, we're going to terminate this. We need to simplify his overall tax makeup. There's too much going on. So first, we terminated the S. The next thing is we did an analysis for cost seg. So we did the cost seg analysis, and we actually found that there was a lot of opportunity. There was even missing real estate that were not being reported in this tax return. So we're like, okay, well, not only are we going to do cost seg and accelerate the depreciation, but we actually found we're getting the books up to speed. So we got the books more lined up. We fired the bookkeeper because we were like, we can do all of this and centralize it and make sure that everything is aligned and accurate. And it also increases audit defense because you don't have books being so different to the tax returns and then the taxpayer not understanding what's going on. So once we did that, we terminated that. We also said, there's no point in having losses here, Renato. We need to pay your C-Corp a little bit more and get it closer to being zeroed out. So that obviously reduced his taxable income by that $18K. Now, most likely he got that $18K because he had put money in and then started paying payroll. And that's how he had losses, was he contributed some money and then he started paying it like it was an outside vendor. So we got that to zero. So now we don't have these losses we can't use because an 1120 is not a flow through. And so we've also lowered our net income by that amount. Well, in addition to that, we finally got the cost seg done, and we were actually able to take an additional $280,000 in paper losses. So even with his wife's income in 2024, he would have paid, let's just say conservatively, close to $50K in taxes. You want to know how much he paid?
Tell me.
He actually got a refund federally of $15K. So not only did we save him $50,000, but he actually made $15,000 in a refund because his wife's W-2, right? And then he actually got another $7K back in California. So all in all, we ended up saving him, if we did the math here, let's see, $72,000 in tax in 1 year. Now, what he's able to do, because his income is within the threshold, he can use that refund and put it in a Roth. So obviously it's not going to be huge money, but that is tax-free, right? So now you can put that refund to good use. And then later on, we're probably going to do a 401k and a defined benefit pension plan, which will allow him to accelerate his retirement and mitigate tax further down the road. Because, cost seg is great, but it's only going to get you so far. It's a chess game. But that's essentially how we did it. We simplified his taxes, overall taxes, terminated the S-Corp. 1065 is now aligned with the books, so the books actually match, and now he's in a good situation when it comes to audit defense. He knows exactly where his money's going. Oh, he also in 2025 hired his kids, because he had 2 kids, and he was able to hire them, have them do some jobs and mitigate his tax further. So that we also did in 2025. So it's a lot. You're going through a ton of different things. You're peeling the onion. You're getting to know the taxpayer's situation. It's uncomfortable initially because you're going through dirty laundry, you're going through skeletons in the closet, but I guarantee you, if you're willing to make those changes, which Renato was, he just needed a trusted advisor to guide him through that darkness a little bit, clarify things, and now he's just in such a wonderful position where he's able to accelerate retirement, not be overpaying in taxes, and his taxes are being prepped accurately. One of the things we always do is we get a wage and income transcript to ensure that we never miss anything that is filed with the IRS. So that's something else we do. But again, this is a part of the process. Now, for someone making a lot more money, maybe they're paying usually $200,000 to $300,000. We've even had clients that pay multiple millions. This process will be similar, but there may be certain things that we don't need to really worry about. They may not have issues in the past tax returns. They may have really good books, but we've even seen multi-million-dollar companies not have great books. So it's still common. And the best thing you can do is get those things fixed so that you can move from reactive to proactive.